Welcome back to Scope. Today we are analyzing the single biggest bottleneck facing the AI revolution. It's not chips, it's not software, and it's not talent, it's raw energy. We are looking at a classic supply-demand mismatch in the uranium market that could define the next decade of infrastructure investing. While the market is obsessed with NVIDIA and AI data centers, they are ignoring the physics of how to power them. We have a structural deficit in uranium supply colliding with a generational spike in power demand. Today, we break down why nuclear energy is the only viable solution for big tech and how you can position your portfolio. And remember, this is Stock Scope. Let's get started.
Let's start with the first principles of physics, because this is the unshakable foundation of our thesis. This image illustrates energy density. On the right, you see a massive pile of wood, 2.5 tons of it, intermittent over 7 barrels of oil. On the left, a tiny handful of uranium, just 100 grams. All three piles produce the exact same amount of electricity, 11 megawatt hours. Think about the logistics. Transporting thousands of tons of coal or millions of barrels of oil is expensive and dirty. Uranium is incredibly dense. This physical efficiency is why nuclear power has the lowest material footprint of any energy source. It is the only scalable way to generate massive power in a small footprint. Now, let's look at the demand side. This chart from Goldman Sachs is terrifying for utility planners, but incredible for investors. For the last decade, U.S. power demand was flat, zero growth. Suddenly, the blue line takes off like a rocket. This is entirely driven by AI data centers. An AI query uses 10 times more electricity than a Google search. We are projecting a 160% increase in data center power demand by 2030. The grid is not ready for this. We simply do not have enough electrons on the grid to power the AI future that Microsoft and Amazon are building. This is the macro shock. Critics will say, why not just build more solar and wind? This slide explains why that is impossible for AI. It comes down to intermittency. Solar only works when the sun shines. That's a 25% capacity factor. Wind is about 35%. That leaves a massive gap of downtime. AI training clusters run. They cannot stop because the wind isn't blowing. They need baseload power, constant, reliable energy. Nuclear provides this with a 92% uptime. For a $1 trillion data center, reliability is everything. You cannot run a 21st century AI economy on weather-dependent power alone. This isn't just theory. The market is already paying for it. We call this the green reliability premium. Look at the pricing. Standard grid power costs around $67 per megawatt hour, but tech companies are voluntarily paying over $100 for green firm power. That is, carbon-free energy that never turns off. Why would they pay a 40% premium? Because for a company like Google or Meta, the cost of power is negligible compared to the cost of downtime. They are happy to pay up for nuclear because it guarantees their servers keep running. This premium pricing transforms the economics of nuclear utilities. We have proof of concepts. This is the biggest news in the sector. Microsoft just signed a 20-year power purchase agreement to restart the 3 Mile Island nuclear plant. Look at the price. They are paying roughly $110 per megawatt hour. That is double the wholesale market price of $50. This deal validates our entire thesis. It proves that an electron connected to a data center is worth twice as much as a regular electron. Microsoft effectively signaled to the market that nuclear energy is now critical digital infrastructure, just like fiber optic cables or GPU chips. So, how do we play this? The first vehicle is Constellation Energy, ticker CEG. They own the largest nuclear fleet in the United States. Think of them as the landlord of these power plants. They have a massive utility moat in the eastern U.S., right where the data centers are being built. Constellation is pivoting. They are moving from selling power at cheap market rates to signing these massive long-term contracts with big tech. This changes their revenue from volatile commodity pricing to stable annuity-like cash flows. It makes the stock much more valuable. However, we must be objective. Look at the valuation chart for Constellation. The price-to-earnings ratio has exploded from 15 times to over 30 times. It is now trading like a tech stock, not a utility. The market has priced for perfection. While the long-term story is great, the risk of a pullback is high here. If they miss earnings by a penny, the stock could drop 20%. We love the company, but at these levels, we are cautious about chasing the rally. We need a better entry point. If the utility is too expensive, let's look at the commodity itself. Uranium. The best way to play this is Cameco, ticker CCJ. They are the largest Western producer of uranium fuel. They operate the best mines in the world. And unlike the utilities, they are directly exposed to the price of the metal. Uranium prices have moved from $40 to $80 per pound. Cameco is currently resetting its legacy contracts. As old, cheap contracts expire, they are signing new ones at these much higher market rates. This means their earnings are set to explode purely based on contract math. This is my favorite chart in the entire deck. The scissors, the dark blue line is uranium demand steadily climbing. The green bars are supply from existing mines. Look at the gap opening up after 2024. The mines are depleting, but demand is growing. We are entering a structural deficit. It takes 10 to 15 years to open a new uranium mine. You cannot just flip a switch. This supply gap is baked in for the next decade. Economics 101 tells us that when demand exceeds supply and supply is inelastic, prices must go up. This is the supercycle thesis for uranium. A quick warning on small modular reactors or SMRs. You've heard about Amazon investing in X-Energy and Google and Kairos. This is an exciting technology, but look at the timeline. We are currently in the hype phase. Commercial deployment is not expected until 2030 or later. Between now and 2030, there is a valley of death, years of cash burn and regulatory delays. While SMRs are the future, they will not generate revenue for a long time. Be very careful investing in pure play SMR startups right now. They are high-risk venture capital plays, not stable investments. To help you execute this trade, we created this comparative matrix. You need to understand the difference in asset class. Constellation CEG is a regulated utility. It offers stability. But as we noted, it trades at a high-tech-like valuation of over 30 times earnings. The risk here is execution and regulation. Cameco CCJ on the right is a miner. It has a more moderate valuation, but carries physical risks like mine flooding or geopolitical issues. The strategy is simple. Constellation is a compounder that provides a high floor for your portfolio. Cameco offers leverage to the uranium price, giving you a higher ceiling, but more volatility. Choose your vehicle based on your risk tolerance. So, here is the verdict from StockScope. The trend is real. AI needs nuclear. The fundamentals are strong. We have a massive supply deficit. However, the valuations for stocks like Constellation Energy are stretched in the short term. We are rating this sector as accumulate on dips. Do not chase the green candles. Wait for a pullback of 15 to 20% to build your position. For conservative investors, look at Cameco CCJ for exposure to the fuel cycle. For growth investors, watch Constellation CEG, but be patient on your entry price. The nuclear renaissance is here, but price matters.